Hello, and welcome to this week's edition of Checks and Balances TV. Today's program is entitled, With the Recent Stock Market Gyrations, Is It Time to Take Some of Your Profits Off the Table? Let's find out in this week's episode of Checks and Balances TV. If you have money in the stock market, I'm sure that you were very excited when the Dow Jones Industrial Average reached their all-time high of 15,409 points back on May 28th of this year. Now since then, it's gone down below 15,000, a little bit above 15,000, so many investors are asking, is it time to take some of my profits off the table? It kind of reminds me if you were in Las Vegas and playing blackjack, which is, 21, and if you started with $10,000 and inside of a couple of hours you're up to $20,000, what would the smart thing be to do you think? Probably take some of those profits off the table. As long as you're playing blackjack, that money on the table is not your money. And if you play long enough, the house will get most or all of your money. You may have heard the name Bill Gross, founder and managing director of PIMCO, which manages more than $1.9 trillion, with a T, trillion dollars in securities. And he said in a recent article that, quote, investors should look for a pacemaker to follow a less risky, lower returning, but more life-sustaining path. It's clear that he thinks that many investors should be heading for the market's exits. And also, most of all of my clients, I like to share with them what I call the investment rule of 100. And unfortunately, most stockbrokers and financial advisors don't talk about this, but if you follow the investment rule of 100, you won't care about what the market does as far as a bull market or bear market because you'll be allocated properly. The investment rule of 100 simply says start with the number 100 and subtract your current age. So if you're 65 years of age, 100 minus 65 leaves 35. Put percentages behind the 65 number and the 35 number. What does that mean? If you're 65 years of age, very simply, 65% of your money should be in safe, guaranteed accounts that have no risk of principal to them. The other 35% or up to 35% could still be in the stock market with risk of your principal. And the reason the investment rule of 100 is so important is as you get closer and closer to the age 100, we really have less and less risk or time available to us to make up for the risk that's involved in having money in the stock market. So if you follow this investment rule of 100, you will be correctly and properly allocated. I do want to make a warning here though, and that is to not have a re-jerk reaction. You don't want to overreact and sell when the market's down and then wait for it to bounce back up and buy in again, because then you're losing even more than what the market would lose or what you would lose in the market with a big bear market. And that's one of the chapters in my new book entitled All the Rules Have Changed, What You Must Do to Succeed in the New Financial Reality. And chapter 9, I talk about invest like a pro. And what I'm really talking about there is becoming a 21st century investor. And what I mean by that is the old buy and hold strategy doesn't work anymore. I call it buy and hope. It just doesn't work. And if you're broke, if you call most brokers when you're down 20, 30, 40%, what's their strategy? They say, well, just hang in there. The market always comes back. Well, that's foolishness. Is it going to come back in time for you to benefit? Depending on your age and risk tolerance and how much you've lost, it may never come back. So we need new strategies. So what I talk about in becoming a 21st century investor is using active management versus passive management. And the reason that's important is that we've had a sideways market the last 15 years. Dow Jones is up, it's down. Dow Jones is up, it's down. S&P 500 is up, it's down. As a matter of fact, in 1966 through 1982, which was 17 long years, we had a sideways market. So if you just buy and hold, what that means is you're never getting above the original high or the last high that the market stood at. So becoming a 21st century investor, and to help you to achieve that, there's two real keys that, again, in my book I talk about, but I want to share with you right now. Number one is working with a money manager who has a stop loss. A stop loss simply means, let's just say that you feel that if you lose 10% in the market, that's as much loss as you want to incur. Well, what that means is the market can go up, 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 but when it comes down 10% or more, you go to the sidelines in a safe money strategy and let the market continue to decline. And then through effective management, there are specific times to reallocate some and then all of that money back into the market when the market does come back up or have another bull run. Very effective strategy to lose 10% and not 30, 40, or 50% with a money manager who's really looking out for your money. Second idea is to have your investments with a money manager who hedges against the downside of the market. Most investors think you only make money when the market goes up, not when you go down. That's foolishness. Becoming a 21st century investor today means just don't buy and hold, but work with a money manager who uses a combination of hedging against the market with what's called puts and calls. Don't worry about that strategy, they handle it. But what it means is when the market goes down, you can literally not lose anything or not lose much, and sometimes even make money when the market goes down. And large institutional banks in New York have done this for years. Matter of fact, you might remember a few years ago, Goldman Sachs was fined by the SEC $500 million for selling to their clients CDOs, collateralized debt obligations and mortgage-backed securities. And when the market went down, they profited $1 billion, even though their clients lost all or a good part of their money. So they were fined $500 million for selling a product that they were hedging against. But the point here is that you can hedge against the loss in the stock market and either not lose as much or not lose anything, or even perhaps gain something when the market does drop in the future. By the way, stockbrokers and financial advisors are not good money managers. You want to work with an established and professional money manager that's a part of a money management platform and fund that has a history of protecting money in down markets. And they're out there, and you should be working with one of those very good firms. To help you become what I call a 21st century investor, I have a special report for you entitled The Truth About Protecting Your Nest Egg from Stock Market Downturns. And I have two reports, report 1 and 2. You can get it totally free right here on our website at Checks and Balances TV. Just click on the download section and you can receive this free report on how to protect your money from stock market downturns and truly become a 21st century investor and not worry about when the market begins to fall apart. And also, if you're looking for what I call a true financial advisor, one that's independent, that has a securities license and insurance license, that's held to a fiduciary responsibility, which means to do the best thing for you possible and not what's in their best interest. If you want to find someone like this in your area, you can call us at 877-575-2288. Again, 877-575-CBTV, or email us at info@checksandbalances.tv, and we'll help you find someone in your area to help you really take advantage of the upside of the market as well as the downside. And also, I want to offer to you my brand new book, which is entitled All the Rules Have Changed, What You Must Do to Succeed in the New Financial Reality. Recently came out. It's an Amazon #1 bestseller. I want to get this into your hands because it's going to carve out a clear path how to reduce debt, how to save more, how to become what I call a savvy investor and smarter consumer, how to have the right insurances in place, the right legal documents, and really build what I call a financial fortress around your money, your family, and your future. So just click on alltheruleshavechanged.com. Again, alltheruleshavechanged.com, and that'll take you to my website. And I have, by the way, 7 terrific bonuses that I want to give to you. Some of my free reports and some videos and some extra things that's going to really help build what I call a financial fortress around your money, your family, and your future. And don't miss next week's show. It's entitled, ready for this? Don't let Wall Street scam you like I did. Wonder who's mentioning that statement. Could it be Bernie Madoff, the greatest Ponzi scheme artist of all time? Had a $65 billion Ponzi scheme? Yes, it's Bernie Madoff. In a recent interview with MarketWatch, he talks about how not to be scammed by people like him in the future. So be sure to watch next week's show. It's going to be very informative for you to keep your money safe. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matt Rettick from Checks and Balances TV. Until next time, dump debt, invest wisely, believe in yourself, and make it happen. This edition of Checks and Balances TV is brought to you by American Equity Investment Life Insurance Company.